Glass shatters. Shouting echoes. Flashbulbs pop. The Treasury Secretary storms out of a closed-door press briefing, his tie askew, papers in hand, face red. Scott Bessent isn't walking. He's charging. Cameras catch just 5 words. We sent the letters. 100, and just like that, Washington goes silent. 100 countries received what Bessent calls tariff letters. But critics argue these weren't letters at all. They were ultimatums, issued with no dialogue, no diplomacy, just an industrialized threat: renegotiate trade under U.S. terms or face tariff rates not seen since the 1930s. According to Bessent, the letters would boomerang tariff rates back to April levels, some as high as 50%. But here's the first contradiction. None of these countries had agreed to talks in the first place. Vietnam, Korea, and Mexico, yes, heavily reliant on U.S. exports. But the majority of recipients, silent. No replies. No outreach. No public concern. The implication: either they don't believe Trump will follow through, or they've already moved on. That silence speaks volumes. According to Bloomberg's global trade trackers, over 63 countries on Bessent's list now conduct more annual trade volume with China or India than with the U.S. That's not politics, that's arithmetic. So why would they enter a lopsided bilateral deal with Washington when they're already benefiting from lower tariff corridors via BRICS? This isn't defiance, it's indifference. And the timing makes it even more volatile. Trump delayed the tariff trigger again. July 7th was the original deadline. Then August 1st. Now Bessent calls it a signal, not a deadline. But markets aren't buying it. The S&P 500 dropped 2.1% intraday the moment Bessent's remarks hit Bloomberg Terminal. Investors weren't reacting to the tariffs themselves. They were reacting to the chaos surrounding them. That chaos includes a $3.4 trillion tax expansion passed just weeks earlier, fueling fears of debt-driven inflation embedded in policy. There's no fixed line, only warnings that don't land, and trade partners who don't pick up the phone. Meanwhile, a second front opens. BRICS. Trump's latest directive imposes an automatic 10% penalty tariff on any nation aligned with what's described as anti-American BRICS policy. But here's the problem. The term anti-American isn't even defined. Is it de-dollarization? Joint infrastructure? Multilateral settlements? By that logic, Germany, a NATO ally, could be penalized for conducting RMB-settled trade with China. Brazil could even face double duties for participating in a BRICS reserve asset program, a program designed to settle trade in commodities like oil or lithium using a shared, non-dollar instrument that hasn't even launched yet. This isn't a line in the sand. It's a moving target painted on the backs of anyone who trades outside the dollar. And yet, Trump's pressure campaign reveals a deeper irony. The United States helped design the global trading order it now seeks to punish: the WTO, the IMF, SWIFT, even bilateral free trade frameworks. These were built, funded, and policed by Washington for decades. Now, as BRICS forms a separate financial bloc, one rooted in non-dollar settlements and raw commodity trades, Washington's own framework is being turned against it. The same interdependence it once championed now acts as a constraint. Let's think critically here. What Bessent calls a trade strategy is beginning to look more like a containment doctrine with no defined boundaries. This isn't diplomacy. This is a shotgun wedding with a ticking clock and no groom in sight. Look at the raw numbers. In 2000, the G7 accounted for 70% of global GDP. Today, it's just under 43%. BRICS? They've risen from 18% to 34%, and that number is still climbing. China alone is projected by the IMF to comprise 19% of global GDP by 2029. Now factor in pending BRICS expansions: Indonesia, Egypt, Saudi Arabia. If formally admitted by 2026, the bloc could control over 46% of global productive capacity and more than half of the world's critical mineral output. So what leverage does a tariff letter really carry in that kind of landscape? Still, Washington insists its size and consumer market offer unmatched leverage. But leverage cuts both ways. U.S. importers rely on $3.1 trillion worth of foreign goods annually, per U.S. Census Bureau data. China alone, despite ongoing tariff tensions, remains the top source of U.S. electronics, batteries, pharmaceuticals, and auto components. Yes, Bessent's tariffs may pressure foreign exporters, but U.S. producers will bleed right alongside them, hit by higher input costs, fractured logistics, and retaliatory strikes. And retaliation is no longer hypothetical. In 2024 alone, BRICS-China trade hit 4.6 trillion yuan, about 650 billion US dollars, a 5.2% year-on-year increase, according to China's Ministry of Commerce. And that's despite European recession signals, US rate hikes, and a global demand downturn. Now imagine the effect of even mild trade realignment under penalty tariffs. With single executive order, Trump could force US allies to reroute supply chains toward BRICS, a pivot that, once made, likely won't reverse. And it's already underway. According to Reuters, over 37 countries have formalized RMB settlement pathways since 2023. The Gulf Cooperation Council just approved yuan-based crude contracts. Brazil and Argentina now clear over 40% of their trade with China outside the US dollar. This isn't theory, it's rollout. The result, a marginal but persistent decline in dollar demand, and with it, a weakening treasury bid. Let's test that claim. Bloomberg data shows that foreign purchases of U.S. treasuries fell by $289 billion over the last 12 months. The largest sellers? BRICS and their top partners. China's holdings alone dropped by $12 billion, its fastest drawdown since 2016. Why? Because with less trade in dollars, fewer dollars need recycling into bonds. Treasury demand collapses. U.S. borrowing costs rise. And Besant's boomerang begins to hit home. Beijing, however, isn't just divesting, it's accumulating gold. The People's Bank of China added 70,000 troy ounces in June alone, bringing its 8-month total to over 34.2 metric tons, per official disclosures. This isn't about yield, it's about trust. Gold doesn't carry U.S. political risk, sanctions risk, or debt ceiling theatrics. And that's precisely what makes it attractive to BRICS. Irony alert. A metal Washington once demonetized is now the asset Beijing weaponizes. Even Europe is moving. In a rare shift, a German church pension fund allocated $50 million to a Hong Kong-based China equity fund, according to the Financial Times. Why? Exposure to high-growth, undervalued Chinese tech and industrials. But the symbolic weight is heavier. This is a NATO-aligned entity parking funds in a market Washington considers adversarial. So while Besant crafts tariff deadlines, BRICS is quietly absorbing Western capital. And markets are noticing. Year-to-date, the Hang Seng Index is up 21.3%. The S&P 500? Just 6.7%. This doesn't mean Wall Street is collapsing, but it does suggest capital is diversifying. Traders are beginning to price in long-term instability in U.S. fiscal and trade policy. And when volatility becomes structural, yield isn't enough. Investors chase systems, not spikes. That's what makes China's next move even more provocative. According to Bloomberg, Beijing is now weighing an expansion of the southbound bond connect, allowing up to 1 trillion yuan in capital flow to foreign debt markets. That's roughly 140 billion US dollars in new outbound potential. It would partially unlock capital controls for China's institutional investors, letting them buy Eurobonds, U.S. corporate paper, even treasuries. On the surface, it might seem dollar-friendly. In practice, it's Wall Street displacement. The goal, according to PBOC sources, is reciprocal flow. China wants to build a mature financial system in Hong Kong, one that attracts inbound capital while granting outbound access. But that only works if investors no longer need Wall Street. And with the Hong Kong Stock Exchange preparing to list more sovereign BRICS bonds, the ecosystem is rapidly evolving into an independent platform, one that can grow without the U.S. and eventually against it. Meanwhile, Trump's fiscal strategy risks triggering a feedback loop. His most recent tax bill added $3.4 trillion to the U.S. deficit per the Congressional Budget Office. At the same time, inflation projections jumped by 1.7 percentage points for 2026. But the distributional effects may be more politically toxic than economic. Data from the Joint Committee on Taxation shows the top 20% gained 2.3% in annual income under the new law. The bottom 20%, they lose 2.3%. So as tariffs drive prices up, the purchasing power of the bottom collapses, just as the wealthy move assets offshore. What happens when the middle class can't consume? Growth stalls. Retail freezes. Small business investment declines. This isn't just theory. It's the 1970s playbook with new actors. Layer in tariff-driven inflation of 15% to 20%, as projected by the Peterson Institute if August rates take effect, and the pressure on household budgets could become unsustainable. And yet, the BRICS bloc continues expanding credit, softening rates, and subsidizing trade. The contradiction is sharp. The U.S. tightens, BRICS accommodates. And the final twist? This entire breakdown may have been built in the very lab that once funded globalization. The U.S. exported the very system BRICS now uses to unseat it. Trade corridors, digital payment rails, dollar alternatives, even infrastructure templates. It's not a coup. It's a remix. And if the U.S. continues to threaten rather than compete, it won't be tariffs that isolate it. It'll be gravity. Will BRICS back down? Will Trump recalibrate? Or are we witnessing the final fracture of the old trade world? Let us know in the comments.